Hey, what's up YouTube? This is Leo with DRIPCalc, and in this video I want to make a prediction for next dividend payment for SCHD or Schwab Dividend ETF. This is the second largest dividend ETF in the world, behind VIG, which is number one, but not by much. Anyway, so without going long, our system shows that we expecting about 76.4 cents per share. Now I think it will be slightly lower, so I would say about 73 cents. And in this video, I'll explain my methodology, how we arrive at this estimate, as well as compare SCHD to some other dividend ETFs, as well as versus S&P 500, and all of that good stuff. Review SCHD holdings, their recent reconstitution, and all of that good stuff. So let's begin. So guys, I noticed that less than 7% of you are subscribed to the channel, so a personal plug. This is a new YouTube channel, so I'm asking you to please smash that like button. It really helps the channel grow. And subscribe to the channel. I'm putting a lot of work into these videos, into the calculators and the tools on the website. So it will really help if you subscribe, help with the algorithm, so more people get to see this. And I want to bring this number to about 10% at least. So please help me do that, and let's begin. Okay, so basically the way we come up with this estimate, this is automated. We have the holdings for the SCHD, they're right here. And we basically take the total number of shares that they hold, and we calculate the total dividend that the fund will collect. So we take the dividend, this is quarterly, and most of them are quarterly. We multiply by the number of shares, and we add up all the dividends, and then we divide it by the number of outstanding shares. Okay, so the number of outstanding shares fluctuates, and with it also fluctuate the holdings. So you can see here are the holdings. So this changes, from day to day, but it generally stays about the same. So actually the outstanding shares went down by about $150,000 in the last 3 weeks, and that means some people pulled out of the fund. But basically this number stays relatively flat, and so do the holdings, because they have a certain percentage of how much they allocate. Anyway, so SCHD actually went through a reconstitution, or basically reshuffling of the holdings, and they removed certain stocks. For example, they removed AVGO, and AVGO had a massive run, over 20% in the last couple of days. We can even see it over here, AVGO. They also removed Merck, which actually I don't like that idea, but I think the reason for that is because the dividend yield, you can see over here, the dividend is increasing for Merck, but the yield is dropping because the dividend increase is slower than the share price increase. So over here, you can see that the CAGR for dividend is about 6.25% in the last 10 years, and a 5.5% latest increase. However, the share price increase in the last year is almost 17%, and the CAGR is 8.66% in the last 10 years. So on average, the share price of Merck increased by 8.66% in the last 10 years. This is pretty amazing. So anyway, so they removed Merck, they removed AVGO, and you can see AVGO just going crazy bananas. It was when they did the reshuffling right over here in March. It was, let's look at share price. So in March it was around 1300. The last couple of days it ran up to what is it now, 1800, so by $500. And if they didn't do that, actually the price of SCHD would actually go up, most likely. Well, I mean, it would go up, but it wouldn't go up tremendously, but it would still have a nice increase in the price of SCHD shares. But it is a dividend ETF, and AVGO is paying very small dividend relative to its share price of 1.16%, and it falls outside of the specs, or how they qualify stocks to be included in the fund. Anyway, so let's talk about dividends of SCHD. So over here it says that the yield, the forward yield, is 3.15%, and it is based on the latest dividend, which was 61 cents, and this was paid on March 25. Okay, it was ex-dividend date was March 20th, and 5 days later they paid. And so figure 3 more months, so June 20th. So my guess, they will announce the next dividend in a couple of days, 2-3 days. They will announce it, maybe by Friday, maybe Monday of next week. It doesn't really matter. So first of all, it should be higher. Okay, because why it should be higher? Because the first quarter of each year is always their lowest, or almost always their lowest dividend payment of the year. So you can see here was 61 cents. Over here, the first quarter was 57 cents, and then the rest of the payments for this year, for 2023, they were higher than the first quarter. Okay, same in 2022, 51.8 cents, and every single payment throughout that year was significantly higher than the first quarter. Same in 21, Same in 2020. You see, all the following payments are higher than the first payment of the year, except for over here in 2019, same story. It was 35 cents, and the rest of them it went as high as 48 cents. So this is how SCHD works. I guess their underlying stocks, maybe the schedule of dividend payouts don't align with the SCHD announcement, and so that, for example, one company will announce, for example, a company announces their dividends on March 26th, but on March 25th, the SCHD already paid out, so they're collecting the dividend, but that goes into the next quarter payment. Okay, so that's how it works. And also they have a couple of stocks that are paying semi-annually, so twice a year, not quarterly. Anyway, so historically speaking, the next dividend should be higher for SCHD. Okay, and my guess that it will be, so last year Q2 payment was 66 cents. Our software shows that it's going to be 76.4 cents. Now keep in mind, because because AVGO ran up, so let's take a look. I'm not even sure when they added it. We have to go back into old holdings, but let's say they added it first quarter of 23, so it went up from like $600 range to 13. So the fund has to pay capital gains taxes on that, and probably long term. I don't think they hold stock for less than a year. And who is paying the capital gains? We do, so that comes out of the dividend payment. However, we did receive the the capital gains, so those went into acquiring new stocks. Anyway, it all balances out. You can of course try to imitate SCHD yourself, but if you are not good at research, if you don't want to spend time on research, because when you're researching companies, like, you gotta look at their earnings. Like, for example, AVGO, like, this is their EPS last quarter, so May 5th, EPS was 442 and PE was 72, and the quarter before that EPS was 284 and the PE was over 100. Okay, and this is much lower than the previous year EPS, and for some reason the price is just like skyrocketing. So you got to take a look at the revenue is like, wow. So I guess they had like some purchases that they made. You see their balance, their debt went up significantly. Like, it almost doubled from 37 to 73 billion, 73 and a half. And their cash pile slightly reduced. You can see their dividends, they are rising, they're increasing at a super high pace. So over the last 10 years, 34%, almost 34% CAGR. So that's an average for every year that it's increasing. And you can look at the dividend, it's a hockey stick, but actually, yeah. So it started 14 years ago at 7 cents. Now it's $5.25 a quarter. So this is amazing growth in the dividend payouts. However, their dividend yield, if you look over here, so we have this nice chart over here with the dividend yield and the payments, and you can see the yield was the highest. It was, wow, 6%. Wow, guys. So you had to buy AVGO basically during the COVID crash, and you would have a massive. So the payment here was $3.25, so it went up by $2 since the COVID, $2 per quarter, and your yield basically went down fourfold. Okay, or down 75%, more or less, but the payment went up about 45%. So if you kept that stock, your yield on cost would increase by 45%, so it would be close to like 8-9 by now. And the share price, amazing growth. Like, look at this. Where's the 2020? Yeah, right here. 2020, the share price was at the bottom, like below 200. I mean, okay, fine, let's not even go there. But anyway, when you're selecting stocks, you gotta look at all these metrics, and figure out, if it's a good stock, if it's growing. Well, AVGO is clearly growing, but there's other stocks, like, for example, Pfizer, and that bad boy is not growing. You can see, so the revenue is basically at the level where it was at the beginning of COVID. You see right here, actually, basically in 10 years, so 13 billion revenue. So it's slightly up from 10 years ago. It had a massive run up during COVID with all those vaccines, but it's basically flat over the last 10 years. So we look at a revenue CAGR over the last 10 years, it's 2.74. And if we look at Merck, their revenue CAGR is 4.41, which is also, I don't know, it's not that great, by the way, guys. It's not great at all, but anyway, it's better than Pfizer. So anyway, SCHD does all of this research for you. They pick out the stocks, and one of their main criteria is the dividend yield. They have more criteria, but so basically they removed these 5 companies. They removed MMM, which I think is a good call. First of all, 3M actually cut their dividend. They paid a massive dividend because they spun off a company, so they basically awarded shareholders with the amount of money that they received for the spin-off, and basically dropped their dividend after, I think they were like a dividend aristocrat or dividend king. They were not cutting dividends for probably 50 years or so, and finally they cut it, which was a good call because they weren't doing so good. So that was the reason why 3M was cut, but AVGO, their price ran up so high that the dividend yield was really low, so that's why they got kicked out. ADP, I'm not sure. So and these are the companies they added: Bristol Myers, Hershey. I'm not sure what this is. Okay, it doesn't really matter. They had 23 removals and additions, and here's the list. You can look at it on your own, guys. I don't have to cover this here. Basically, so going back to their dividend again, I expect an increase, and if you compare Q1 of 23 to Q1 of 24, it was a very small increase. But then if you go 52 cents in Q1 to 60 cents in Q2, so that was a massive increase. It is over 10%, I believe. Anyway, so I think that we will have about 73 cents per share in the second quarter of this year, and that will be announced in a couple of days. Maybe 72 cents, I don't know, because we also have to pay for the capital gains. Also, these holdings, they only include, now you can see the whole list over here, and we have the percentage of the fund that each stock holds, their dividend, the yield, and whatnot. So PFE, the Pfizer, it's actually a holding in the SCHD, and it's paying 6%, which is pretty massive. Now their share price is not doing so well, that's why the yield is high. But they have Pepsi, they have Verizon, also high yielding, and the stock actually has been doing better. So if you look over here, they really bottomed out in October of last year. So over here, like I think they were below 30 bucks. So you can see 52, yeah, just at $30.14, and now it's sitting much higher. And so over here it peaked at like $40. So it was a massive increase, 30-some% in just a few months. But anyway, it is part of a SCHD, so all these dividends, they get piled together and then divided by the number of outstanding shares on the ex-dividend date. So again, the ex-dividend date will be around June 25-ish, because that it was March 25 last quarter, so give or take 1 or 2 days, and by then they basically figure out all the holders of the stock, they record it, and then they distribute the dividends. All right, so that basically covers our methodology. This again, a little bit inaccurate because it doesn't account for cash holdings and, like, you know, bonds, treasuries, all of that good stuff, which also make up the fund, and it's a little bit difficult to calculate because those change way too often, and figuring out the yield on those, it's not fun. So they contribute maybe 1 or 2 cents to the total amount of the dividend, so it's not really important. So going back to this 3.5 yield, I think the actual yield is much higher than that. I think it's more like in a range of 3.5. It's about 10% higher because it looks at just this one dividend and basically multiplies it by 4 and divides it by the current share price and gives you the forward yield. But if you average out last year payments, you know, then it was more than 61 cents. It was more like around 70 cents, 68, 69 cents. And if you calculate based on that, then your yield changes. So right after they make the payment, their forward yield will change, and trailing 12 months yield will also change. So regardless of that, that's my estimate. Now let's see how this stock compares, how a SCHD actually compares to other dividend ETFs. So SPY is the number one go-to, or SPY or WU. Most actual investors go with WU because it has a lower fees, and so it actually has a slightly higher return than SPY. Like, it's insignificant over 10 years, maybe 1% in total, but that is derived basically from lower fees of the fund, lower cost. Okay, and so if we look at these two guys, so the total return for SPY, but you have to consider SPY is basically an S&P 500 mirror fund, and S&P has been beating all-time records 3 times in the past week. Okay, so today it's up also a little bit, 0.14, so that means S&P 500 is up by 0.14% today. All right, and so 234% total return versus a measly 175% total return for SCHD. The interesting, well, you can see here during the last years, the 2023, 2022, during the quasi-recession that we recently had, or the bear market, SCHD was actually outperforming S&P 500 by a significant margin. So it was 160% versus 140% for WU. So, but then as the AI mania started, look at this hockey stick. The S&P 500 just went up like crazy. So basically, I want to make a different video about just compare SCHD to S&P 500 and what it means as far as retirement and collecting dividends, because you can see yield on cost for S&P 500, if you invested 10,000 into WU or SPY or whatever, any S&P 500 fund 10 years ago, your yield on cost today would be 4.1%, which is not that great. Okay, but if you invested the same $10,000 in a SCHD, it would be almost 9%, and that's with dividends reinvested. However, your total return, if you compare here, it is about 60% difference more in the favor of WU or SPY or S&P 500, and therefore, like, if you're about to retire, or if you want to retire, and is it better to invest in S&P 500 or in SCHD with the goal of retiring in the future and collecting dividends, and how much you would be retired. So it's a whole different topic. I want to cover it in depth, so I'm not going to go into it right now. So if you want to know that, subscribe to the channel. You will get notification when that video comes out. So a couple days from now, I plan to make it. It's going to be a big project for me to make. So yeah, but overall the SPY outperformed SCHD in the last 10 years. However, like even a year and a half ago, SCHD was way above SPY. Okay, so over here the difference was 30% in favor of SCHD. So it basically depends on how the market is currently doing. Also, you have to keep in mind, guys, and this is very important, is look at the price of SCHD. So the return is combined dividend collected and price appreciation. That's the total return that we calculate here. Okay, and so the dividends for SCHD, you can see the 10-year growth is 9.44%, and that's because of the 61 cents. So in a couple of days this will recalculate and it will be above 10% CAGR, which is amazing, guys. Like, your dividend basically increases by over 10% every year. Okay, but here 1 year increase is only 4.23% because you compare the 61 cent versus this 60 cents. So that's how it calculates the 1 year CAGR. It doesn't compare it to like the 66 cents. It would actually go down, but we gotta compare like quarter a year ago quarter. So Q1 in 24 versus Q1 in 23. That's how it's calculated. And then when we receive in the 70-cent range next payment, that will bump everything up, because then it will be comparing against the 66-cent dividend rate over here. So these numbers will change. And for WU, for SPY, the dividend increases are only 5.4% per year CAGR. And in the last year, look at this, only 3.73%. And if you look at this dividend chart, this red line, that's the yield. So you started at 1.83 and you ended at 1.54. So you can see a clear downward trajectory for the dividend yield on the S&P 500. So what this means is the share prices of the stocks that make up S&P 500, they outpace the dividend growth, and you can see it clearly here. The share price CAGR is 24% in the last year and 11% in the past 10 years. That's CAGR, which means compound average growth rate. Okay, so 10.84% per year. That's the average growth rate over the last 10 years. And for a SCHD, it's only grew by 7.22%. And in the last year, you can see like it's 24% versus 5 3/4. So why I'm going there? Basically, you can see in the last 3 years, so June 15, and we have June 18 today, the price of a SCHD is completely flat. So June 8th it was $77, and today it's $77. It hasn't moved at all in 3 years. Whereas SPY in 3 years, so we go June 400, today is 500. So it moved by 25%. That's why you have this like massive outperformance over here. You see this hockey stick. But you know, one thing is share price appreciation, but unless you sell, you don't really get anything. However, with a SCHD, you actually have a growing dividend yield. So the actual money you collect is growing. And now if this is in a tax sheltered account, you actually don't pay any taxes on it. If you collect it in a taxable account, then you actually pay taxes on more dividends collected. So if we go here, in the past 10 years, you have collected $5,500 on a $10,000 investment into SCHD. So you collected $2,500 more, exactly $2,500 more with SCHD versus SPY or WU, and so you had to pay taxes on it if this was a taxable account. And yes, your yield on cost is higher, but you also had to pay taxes along the way. And even if it's 15%, you're paying 15% on $2,500. That's like $250, $375 that you had to pay in extra taxes. So your total return minus $375 would actually be 27, like 170 something. Okay, so it would be even lower, and this total return would be lower if you had to pay taxes on those dividends. So yeah, and again, this is a conversation for a whole different video. I just wanted to kind of touch the water on it, but overall you can see the yield curve, dividend yield curve on the SCHD is growing, which is actually a very good sign. So that means that the dividends grow faster than the share price, and the share price doesn't always grow on SPY. You can see over here it went actually negative compared to a SCHD in 22 and parts of 23, like all the way until like March of 23, when Nvidia just skyrocketed on earnings, and that's when SPY took off, or S&P 500 took off, and SCHD just stayed flat. You can see on this price chart it stayed flat, which is very unfortunate. Yeah, okay, but that means actually that it has room to run. Will it run? I am not sure, because currently it's all about tech, it's all about AI, and the companies they have here. So they have Texas Instruments, their biggest holding. Right here we can look at Texas Instruments, and it has had pretty good run, and you can see here the share price dipped significantly. This was a good time to buy anything pretty much in October of last year, but it went up from $140 to like almost $200 over here. The dividend yield on it is not dropping, which is good. That means they increase dividend at about the same pace they increase the share price increases. So actually it's a good stock. It's a good stock. So 10-year dividend increase, wow guys, almost 16%, and 10-year share price CAGR is slightly lower. So the dividend is growing faster than the share price. It's a good sign. Payout ratio, look, they're actually paying out more in dividends than they're bringing in net profit. So you can see here, wow. So they had, wow, look at this. And this is, guys, why it's important to do stock research like this. You can see their EPS has been going down since basically end of 22. It was right here, it was 249, and last quarter was down. Wow, it's down 50%. I don't know how that works out, because they're, yeah, and the P is rising. This is insane. So now EPS and free cash flow. Let's compare those two boys. So yeah, over here, EPS 249 versus 216 free cash flow, and here $1.20 EPS versus negative free cash flow. So this is super bad. This is not good. And yeah, their debt is growing. So it looks like a good stock. Everything is growing. Share price is growing. The dividend is growing. But look, the free cash flow doesn't cover the dividend. The net income doesn't cover the dividend. So they're about. So when they're above 100%, that means they're paying out more in dividends than they're collecting in revenue, in net income. And so anything like, basically for a company like Texas Instruments, anything above 60% is already uncomfortable territory, but they're above 100%, which means they make less money than they pay out in dividends, and this shows in their cash balance. Well, this is funny, because their cash went up. They probably had a dilution. No, they didn't. I guess they just borrowed money to increase their cash position right here. So they're using that to pay dividends, because their revenue is decreasing. Look at that. The revenue is 3.29 versus 3.66, so it's basically flat. Look at the revenue. It only grew by 2% per year in the last 10 years. And in the past year, it's down 16%. In the past 2 years, down 13.61. So that's a very bad sign. I'm not sure why Texas Instrument prices is, why it's skyrocketing like this. Look. Couple months ago, the 166 over here, it basically touched $200. That's pretty insane. Maybe there was some news. I don't really follow this stock, but technical analysis shows that it's not a very safe stock right now. If before I buy it, I would definitely do a really in-depth research on it. So they have good profit margin, like 44%. That's amazing net profit margin. But now, look, it dropped from basically 45% in 22 to 30%. So it dropped by 33%, and yeah, in 1 year, basically 22% in 1 year. CAGR for 2 years is 18, so times 2, that's a combined 36% drop in net profit margin. Gross profit margin is going down. Price to sales is increasing, that's not good. Price to earnings is increasing, that's not good. Look, their average PE has been around 20. Now it's almost like 36, almost 36. I think it's way overpriced. I don't know why people are paying this much money for this company. There must be something in the news, I don't really know. Return on capital employed is going down. Return on invested capital is going down. So I don't think it's a very good stock. And on top of that, it's #1 holding for SCHD. So basically, yeah, you guys, if you want to buy CHD, what is this? They probably interesting. 607. What's going on? Let's look at dividends. Forward yield. This didn't get updated. I don't know why. So we have to fix this also. But anyway, you can see that this is Amgen, their second biggest holding, also going up. Really nice return. So by the way, just holding Amgen by itself is actually a much higher return compared to SCHD. The dividend yield is similar. Price appreciation is amazing. Dividend growth is amazing. Actually better than the SCHD itself. What happened here? Wow, massive dump because of negative EPS. So their top holdings, so cash going down, debt also kind of going down, so that's good. But yeah, revenue slight increase, but not that good. Actually, 10-year CAGR in revenue 5%, so that's not great. 1 year 22%, so that's amazing. But negative net income, that's not very good. Again, I am not saying that you should or should not buy this company. I'm just using this tool for researching and just a look at their top 2 holdings. But anyway, guys, so this is basically my prediction for SCHD next dividend payment. Again, I think it will be around 72-73 cents, and we will see what it actually is once they announce it. I have a few shares of a SCHD and my cost is actually below $70. I think it's a little bit overpriced now, especially with the reconstitution they just made. Now I'm sure Texas Instrument will recover. I am sure Amgen will recover, but I think both companies are severely overpriced right now. And because they make so much, so these 2 companies together, they make up more than 9% of total SCHD holdings. And both of them, I don't really like their performance. And you can go down this list and look at them. Like Cisco is also not very good. Abby I like, but it has run up in price significantly. I think it's a little bit overpriced right now, especially given that their blockbuster drug when like their patent expired and a lot of like aftermarket manufacturers came in and made an alternative based on the same patent, so they lost quite a bit of revenue from that. So yeah, SCHD is very popular, but there is a reason why it's not growing, and you got to do your own research. And by the way, guys, if you want to try out the software I'm using with all these reports, we just recently released it, so it's a DRIPCalc Pro. If you want to try it, we will leave you a link in the description below. It's a 2-week free trial, and actually for our YouTube subscribers we offer a 30% lifetime discount. So if we increase the price in the future, you always paying 30% less than with the prices today. The price will never change for you. For the new subscribers it might change, or we will take away the 30% discount, but you will always get that price for life. So I will put the link in the description below and with a coupon code. And again, thanks for watching. My name is Leo with DRIPCalc. If you enjoyed this video, please click that like button. If you hold a SCHD, let me know how many shares you have, if you plan to hold it, if you are getting more of it, if you want to get out of it. And also, if I made some mistakes in my analysis of SCHD dividends, let me know. I make these videos to learn together with you, to help people get educated about stock research, and that's why I created this software. I actually created it. Funny thing, I created this software to prove to myself that SCHD is a better investment than SPY or S&P 500. And I'll go into those details when I make a video comparing SCHD to SPY. This is why I created the software, but I think it's very useful. So if you want to try it, again, 30% lifetime discount. So go ahead and subscribe to get the free trial. If you like it, you can keep using it. If not, just cancel, and you won't be charged. Okay, guys, again, smash the like button, subscribe to the channel, and come back for my analysis on SPY versus Wu. That's coming up in a few days, so I'll see you later.